Welcome to Private Lending Insights. I'm your host, Rocky Butani. In this episode, I interviewed Christian Faes from F2 Finance. F2 was formed just a few years ago, but Christian had previously founded and built up a large private lending shop in the United Kingdom. We talked a little bit about his journey, but mainly focused on F2's loan program and specific guidelines. We talked about the states that they lend in and F2's capital source. I hope you find this episode to be insightful. Here's my conversation with Christian Faes. All right, Christian, thanks for joining me for this episode of Private Lending Insights. We've had you on our platform for most of last year, and you have a unique loan program and a unique story. So I wanted to get you on to talk a little bit about your story and your loan program and what you offer to real estate investors and brokers.
Great. Yeah, thanks for having me, Rocky. I'm really glad to be here.
Absolutely. So let's start off with a little bit of your story. You started a successful lending business out in the UK, and then you moved to California and started F2 Finance. Tell us a little bit about that journey.
Yeah, sure. So it's been a long journey, I guess. I'm originally Australian, so grew up in Australia, was originally a lawyer, studied law, was a lawyer and acted for a couple of private lenders in Australia. So I sort of got to know the private lending space, or I guess from the other side of the table, being an attorney, putting together the loan documentation and working on enforcements and all that kind of stuff. And then had a small lending business in Australia, but moved to the UK sort of around the time of the financial crisis. So it was a pretty terrible time to be starting a business, but I crazily set up a private lender there called LendInvest. And that business, I spent about 15 years scaling that business. We raised VC capital, and we're very focused on building technology and kind of, I guess, like similar to like the Kiavis of the world here in the US. And we scaled that business. We through to IPO. So IPO that business in 2021, and then I sort of stepped back from the business and are less involved. I'm still on the board there now, and a large shareholder in the business, but I'm no longer sort of involved day to day, certainly. And it's a large scale business. We do about probably in US dollar equivalent about $2 billion a year of lending. So we're one of the largest non-bank mortgage lenders in that market, and and it's a good business. I guess when we raised VC capital in like 2015, 2016, we started to look at the US market, very sort of kind of ambitious in terms of, I guess, when you raise VC capital, you got to go and try and take over the world. So at that stage, we started looking at the US market and fancifully thought that maybe we could go into the US market with that business. Fortunately, we didn't do that, but because I think we would have got killed trying to sort of come into this market. But I guess since that time, I've had an eye on the US market and been relatively familiar with it. Had sort of known from the early days the guys at Pier Street and Lending Home, now Kiavi and so on. So kind of had a reasonable feel for the US market, and was always keen to have a go at building a business here. So so took the opportunity to move here and set up F2 Finance.
And why California? Did you have any ties to California?
Not really. We had well, I guess we did. We had a holiday house here. So my wife's Australian as well. Living in London for sort of 15 plus years, kind of LA was kind of the halfway point, although it didn't make a lot of sense for when we were going back to Australia. So we'd do Christmases and Easters here, and sort of got familiar with LA as a city. And so it kind of felt like the logical place for us to land, and kind of we're very happy with the lifestyle here and living in California, despite kind of some of the challenges of regulation and all the sort of stuff that goes on here.
Nice. And since you already were a little familiar with the US private lending market, and you already knew how competitive it was, especially in California, how did you think about that when you were looking to start up a new business here?
Yeah, it's a good question. I mean, it's kind of I think I spent a bit of time just when I've sort of got here trying to figure out like where's the white space. And I think you learn pretty quickly in the US market there's not a lot of it. Like kind of there's a lot of competitors, very competitive, a lot of money, a lot of very sort of sophisticated players. So it was interesting. But one thing I did do is, one of the early things I did is I went to like the AAPL conference, um, and I found it quite interesting. You walk around, you get the tear sheet from all the lenders that are there, and it kind of felt like it was all very similar. You know, they all kind of had, it's a broad generalization, but they all kind of had like the same product sheet, in terms of, you know, the same minimum FICO scores, same sort of LTVs they're lending to. They weren't sort of lending to foreign nationals and kind of mainly focused on resi and so on. So I thought that was interesting. And I guess as you sort of look at the way the market's set up structurally here is, I'd say the vast majority of the market sort of sell their loans, or have like big bank warehouses, or they sell their loans to aggregators that then go and securitize the loans. And so ultimately, kind of the credit box that they're underwriting to is one that's determined by sort of institutions in the background, and that's why that all kind of looks the same, I guess. So from my perspective, I thought I don't want to go and do that because it kind of feels like that's really a marketing business where you're just originating to a box, and obviously people do it and they make good businesses out of it. But for me, I wanted to do something that was slightly more interesting, and really ultimately have proprietary capital rather than just sort of selling our loans. So what we did was just basically set up a balance sheet, which is how we started the LendInvest business. We had sort of a little bit of capital and raised a fund there, and that's what we've done here. So I've gone and set up a fund. So we are a true balance sheet lender, and I think we do then offer a product that is quite differentiated.
Right. And let's get into that and talk about the loans that you do offer. I'll come back to the geography, but from what I know, you lend in 15 states, in various parts of the country. Tell us about the loans that you offer, like the property types you like. What are the loan amount ranges, your leverage, pricing, and borrower requirements?
Yeah, sure. So I guess coming back to that kind of like the genesis of the business is trying to sort of create a credit box that's slightly outside of where probably the vast majority of the market is. So in terms of asset types we like to lend against, well, we say we can do anything, and technically we can. So we have and do lend against vacant land. We do it in a pretty cautious way, but we can do mixed use, commercial. If it's a real estate asset, we can lend against it. We are taking a portfolio approach. So, if we've done too much of a particular asset class, we will try and sort of like originate less of that. And we're also trying to price for risk. Pricing, we're kind of like as low as 9.9 through to kind of like 13. We try and sort of, again, get a good spread there. Don't want to do all of the book at 9.9. Don't want to do it all at 13 either. FICO scores is a sort of an interesting one where we can be pretty flexible there. I think we openly say that we'll lend as low as 550. The reality is, if it's less than 600, I mean, I've heard the joke a few times. You've got to try to get a FICO less than 600, and I think there's probably a bit of truth to that. And so we've done it. We've done a little bit of that lending. It kind of ends up being quite scrappy and probably not really where we want to be. And actually, across our book, our average FICO is about 700, so it's actually pretty sensible. But again, we can do lower FICO, lower LTV. So if someone does have a 600 FICO, but it's a 30% LTV against an SFR asset, then that's the sort of thing we would look at, as long as we can get a bit of an understanding of what the borrower's circumstances are and why kind of we're not catching a falling knife, but there's kind of maybe someone's gone through a period of time in which they're going to come out of and sort of be a better credit risk over time. And then in terms of LTVs, we don't really compete too much on LTVs, so we're more around about 75% max. I think we do lend up to 80, but pretty rarely. We really try and focus on a borrower that's got a bit of cash or is not trying to leverage every last bit out of it. And that's, we kind of think that's a sensible sort of risk profile. So it is pricing for risk and trying to take a sort of bespoke underwriting approach.
And what
Yeah.
about the loan types? Are you mainly doing purchase and refinance bridge loans? Is there value add rehab? I believe you're not doing any ground up construction, right?
Yeah, so we don't do any ground up construction. I think when we set up the business, I certainly thought RTL was kind of where we probably would be. Typically, though, it's like stabilized assets. So it's maybe a cash out refinance where someone's done the fix, but they haven't done the flip, or they just need a quick purchase. And that's probably where we do excel. I think where we can be very quick and provide really good service, which I know in this business, like everyone says that, but we spend a lot of time reviewing our customers after we've lent to them and working with our brokers and so on. And they do say, we are very, very quick. And I think some of that comes back to being a true balance sheet lender. If we like the deal, we can, we're actively working on their side to try and get it done. But yeah, it's typically a stabilized asset, typically bridge 12 months or less. We can go up to 24 months, but we prefer, I mean, it's very hard to get your head around why a borrower can fund those interest rates or would even want to for longer than 12 months. But there are instances where it might make sense, and we can do it in those cases.
And the leverage you mentioned, 75, 80% maximum. I'm assuming that's for a purchase. What would you go up to on a cash out refinance or just a straight refinance?
Yeah, cash out refinance would be more around 70% if it's a decent FICO. I mean, again, we will be pretty cautious on cash out refinance, try and understand what are the purposes for that. But there might be reasonable ones. Like we did one recently where it was as it was last week as a partner buyout. They kind of, if they can move quickly, they can get their partner out. Then it's just obviously a cash out, decent asset. They've sort of built the house. They're just put it on the market for sale and so on. So in that instance, like we're not too fixed around, oh, it has to be within a certain LTV. It's more trying to understand what the story is. But yeah, again, LTV is not really kind of like, if someone comes to us, max cash out, it's sort of, that inquiry may not go that far unless they're prepared to be a bit more sensible around like, what do they need the cash for, and trying to understand what's actually going on.
And you mentioned a partner buyout. Could you tell us about some of the other scenarios that you've seen that you've actually funded where they need a cash out refinance or a purchase, and then what's the exit strategy in a lot of those cases?
Yeah, so that was the interesting one last week with the sort of cash out partner buyout. Exit is a sale. We did one earlier this week, which is a house in Los Angeles that was like quite flood damaged, and so like, but it was an experienced borrower. We've dealt with them before. We know their track record. And kind of like an asset that I guess most lenders would look at and think, oh, this is pretty scrappy. But again, it's like 60% LTV. He basically was telling the seller that he was a cash buyer, complete in like a week. Great. I love that sort of business. Similar, we did a decent sized business, just a loan in Miami, a house purchase. Again, guy had a pretty decent earnest money deposit down. The seller was being quite aggressive and going to sort of take that deposit. And he needed like $3 million to complete the purchase. We did that within 5 days. And again, good FICO borrower. These people can get out of the loans, but they kind of, there was a sort of a little quirk on his without going into too much detail, but a quirk on his background that kind of like we could understand, but a traditional lender might need a little bit more time to do. So they'll just refinance us out.
And what about a commercial property loan that you've done?
We're pretty cautious on commercial. Like it's hard. It's interesting because investors ask us that when we're on the fund side, sort of talking to investors. We do say that we're focused on residential, and that's kind of the majority of the book is kind of like 70% probably on residential assets, but we can do commercial. And then the typical thing an investor will say was, "Well, tell us about a commercial deal that you like." I think the ones that we like are actually quite low LTV. So, and that's how we can kind of get our head around it, where it's, we did one recently, it was a restaurant, but again, it's not like, these are not landmark deals in terms of, lending against a restaurant in Denver in Colorado. Not, that's not probably like the greatest loan, but it was like a 20% LTV, good FICO borrower, good asset. They just sort of needed some cash because they were going to buy another business. And again, we sort of verify all of that. So it's less that we're sort of chasing lending against that asset class. It's more that kind of like it's a situation that made sense. And so it's a real asset that's got value, it's got income. We can sort of get our head around it.
And how about a land deal? Have you done any land deals in the last 6 months or 12 months?
We've probably done more land deals than we would like to have done in some respects from a portfolio perspective. But I think the ones we do, we kind of like. So where we've done, I think we've done 3 in the last 12 months is in the Palisades, the Pacific Palisades here in LA, where houses burnt down. Again, some of those have been pretty low LTV, sort of 50, 60%, 60 the higher end, but that's kind of a market and where these buyers were buying relatively well. I mean, it's been an interesting market. Obviously, there's a lot of stock down there, and trying to sort of figure out where that lands. But I think we're pretty well covered there. Again, sort of borrowers that have a track record of building houses, and so we won't fund the build, but we'll fund them to sort of move quickly and acquire the asset.
And what would be the leverage on that? How much would the...
Yeah, it's sort of like 50, 60%. Yeah. There was one that we did was like 20%, which it didn't even really make sense, but we kind of happy to do it. Just to sort of, keep the wheels spinning and try and build a relationship with that borrower.
Meaning it didn't make sense that the borrower was putting down 80%.
It's just a small loan for us. Yeah, it didn't.
Okay.
Yeah, it did like 80%. Like, why is he kind of coming to us for a couple $100,000? But again, it's sort of it's taking a relationship view, and we kind of say our minimum loan size is 300,000, so 300,000 through to 3 million. But we'll often do lower than that, and we can do a little bit more than 3 million again if it kind of makes sense.
Okay.
Not having too firm a credit box and trying to sort of have a real portfolio approach to sort of how does the book sit at any particular month, and where do we want to sort of take things.
Okay. Nice. And going back to sort of the lending activity, you said that you left LendInvest in 2021. So I'm assuming F2 was just started in 2022 or 2023. Is that correct?
Yeah. Yeah, I started in 2022. We moved here in 2022. I started. We didn't start till 23, and I was doing initially just some lending with my own capital, trying to sort of eat my own dog food in terms of like just learn the market, trying to get a feel for things. Actually started off buying some notes, and building some relationships with other lenders that kind of have now become good partners and kind of like referrers of business and kind of people that have helped us get embedded in the market here in the US, and that was a great way to sort of learn the market. But been ramping up certainly through the course of last year, as we sort of get more comfortable with what we're doing and get more capital into our fund and get some more backing from the institutional side as well.
And with some of the data that we have access to through Forecasa and Elementix, it seems like your loan volume last year was somewhere in the range of 45 to 50 loans. Does that sound about right?
Yeah. It's a bit more than that. So we've done a couple of hundred loans in the last couple of years, and that was ramping up through the course of last year. We've got a couple of vehicles that we lend out of, including our fund and then 2 SPVs. So I'm not sure those. We've got SFR analytics, which we use as well. It's pretty accurate, but not. Yeah. So we are a small lender in the scheme of things for sure.
That's still a pretty good size for the amount of time you've been in business.
Yeah, it's good from a standing start. I mean, I guess I'm coming from the perspective of like, only a few years ago I was running a business that was doing a lot of volume, and now I'm kind of like back into the weeds of, inch by inch growing the business. But I've enjoyed it. It's been a good challenge, and certainly have ambitions to be a big business as we evolve.
Right. And tell us about some of the trends you've seen in the last 2 years. Has anything surprised you? And anything significant that you've seen happening?
I think the most surprising thing is just like the liquidity of this market is really interesting, and I think just the weight of money that is chasing this opportunity is quite interesting. That flows through to it being uber competitive. I think it also, to some extent, de-risks the asset class. So, in the UK market, which I'm sort of most familiar with previously, the average mortgage takes 3 to 4 months. It's just a very slow, that's obviously on the conventional side, but it's just a very slow moving property market. We used to think it was really competitive there because there's like 100 private lenders. You come to the US, there's 8,000, and kind of like there's rated securitizations and kind of institutions of all types, from sovereign wealth funds to insurance companies and so on, sort of chasing origination. And so I think, when we have had borrowers that have got into trouble, which is kind of like a natural part of lending, I've often been surprised that they've been able to find a way out by another lender that'll take on the loan, or they can sort of figure it out. And so that does put a bit of a safety net under the asset class. I don't want to sort of rely on that, but that has been a sort of a surprising part of seeing that in action here in the US market.
Nice. And how about since you mentioned bars getting into trouble, have you seen a good amount of defaults? Have you gone through a full foreclosure?
Yeah, we've been through a couple. Yeah, which I think is kind of like par for the course. I think it's I always try and sort of spin it to an investor that it's a skill set that a lender has to have. So, I think we now have some capable lawyers that we work with and a bit of a team, and sort of know our way around that. And again, that process here is very different to other markets, particularly in the UK. For example, like the borrower keeps their equity in the asset. So you kind of like, perversely, the cash for keys in that market is more of a concept that makes sense in here in the US market, in terms of, if it goes into default in sort of in Australia or the UK, basically you've got to cut the borrower a check once you sell the property, and you're under a duty to get fair market value, and kind of like all these kind of restrictions on you. Where here in the US, certainly you deal with a state like in Texas, where you can, in 45 days, you might own the asset, and the borrower's equity is kind of going to be quite challenged if they can't find a way out. So again, I think that kind of makes for a very liquid asset class here in the US, and kind of, yeah, it's kind of something we're getting familiar with. We prefer to have, less defaults. Obviously, we don't really want to be in the business of foreclosing on assets. But yeah, we've done it.
And let's go into geography. You have 15 states that you lend in. At least that's what's listed on your private lender link profile. How did you choose those 15 states when you first started F2, and do you plan to expand that, or are you happy with just those 15 states?
Yeah, great question. I mean, it's actually 16 now. So we've just started lending in Arizona, got our license there.
Nice,
In
congrats.
terms of how we've chosen those states, we're focusing on non-judicial foreclosure states, which, with the exception of Florida, which we are pretty active in. And I guess from my perspective, the thinking there is just trying to de-risk the loan book as much as possible. And again, I'm talking about it being a very liquid asset class because that's our experience. But I know there's some markets like New York or say Hawaii where it's probably, maybe people actively in those markets are not talking about it being that liquid an asset class, in terms of the foreclosures just taking a very long time. So we're trying to focus on states where, in a worst case scenario, we can have recourse against the asset and ultimately recover our investors' capital and just sort of recycle it into new loans. So that's the main thinking with those states. We're most focused on California, Texas, and Florida. We kind of are comfortable with the liquidity in those markets, although sort of the more we lend in, Texas and Florida, they've been pretty sticky kind of markets, I would say, the last 12 months. Like, it seems like borrowers are taking longer to get exits there, and we're particularly cautious around what parts of those states we're actively lending in. But yeah, the thinking is kind of, we can be in those states. I mean, we don't say it publicly, but let's say we've got like 100 million of capital we're managing at the moment. That's growing. I don't think we need to be in 50 states with the quantum of capital we've got. So we're kind of like just focusing on having a good performing loan book, and we'll grow over time. And I think it would naturally make sense to be active in more states, but it's not like something we're sitting here going, oh, we wish we were in Nevada. Although Nevada probably is a good state to be in. But yeah, we're happy where we are at the moment.
And tell us about, you mentioned non-judicial foreclosure states, but with the exception of
Mhm.
Florida. So what was your thinking in Florida, and what's the foreclosure process like over there?
Um, not that I'm an expert, but Florida, I think it started really. We had a couple of introducers that we'd built pretty strong relationships with, started lending there. I mean, I think, look, the first thing you always say is that a lender sitting here in Santa Monica, when we're getting a deal in Florida or in Texas or, wherever it is outside of our local area, it's like, why is it coming to us? And I know as an early lender coming to a market, you're definitely seen as a sucker and a target for kind of like for crappy deals. So yeah, we saw our fair share of that early on, but I think now Florida is a market that we do have good introducer relationships. We also have some good borrowers that are repeat borrowers, that are kind of pretty good relationships. I like going to Florida. I've kind of stay in touch with those people personally, and I think we've just managed to build a decent book of business there. Um, on the foreclosure side, yeah, it's just a bit harder. It is a judicial process, so you got to serve the borrower, go through court filings and all that kind of stuff. Having said that, it's still pretty pro lender. You can sort of go through that process in 6 to 9 months and kind of like do a recovery. But yeah, and I think it's pro lender, it's pro business just generally, and so yeah, I think it's a good state to have be participating in.
And you said only certain parts of Florida. Which markets within Florida are you lending in?
Well, I try and not be the sort of expert of like the the origination side. So I'm guided by my head of credit here that kind of is more of an expert and very data driven on this stuff. But kind of like it's the main city centers. So Miami is probably the place where we do most business. Boca Raton, a little bit in Jacksonville, kind of like the main areas.
Okay. How about the
Yeah.
west side of Florida? Is that of any interest? Tampa.
We have done some lending there, but I'm just always nervous turning on the TV and seeing a hurricane go through there, where the asset's still there. We have done some in the early days. I think we would still lend there. I think we would just be quite cautious around making sure we have the right insurance cover and we're pretty covered from an LTV perspective, and ideally lending to a borrower that's got maybe a portfolio of assets and kind of like we're not just leveraged against one asset in one area.
Sure. Makes sense. All
Yeah.
right. With that, why don't we take a quick break and we'll be back in 1 minute. Support for the show comes from Forecasa, an amazing data platform for private lending and real estate investing. Private lenders, note buyers, capital providers, real estate investors use Forecasa in a variety of different ways. You can see which lenders have funded which loans. You could see which real estate investors have gotten funding or sold a property or purchased a property. You can see loan assignments to know where the loan was sold to after funding. Many people use Forecast as a prospecting tool. I personally use it to vet lenders and for general market insights. It's become an essential part of our business, and I just wish I had access to it sooner. We publish some of Forecasta's data on privatelenderlink.com. When you do a search for lenders, you could see the top 20 lenders in each market, and we've also added the top real estate investors in each state and for some of the metro areas. Visit forecasa.com to schedule a demo, and please mention that you heard about them from LenderLink and the Private Lending Insights podcast. And we're back with Christian Faes and F2 Finance. So we talked a little bit about Florida. Tell us about Texas. What's your take on Texas as far as lending? What are you seeing in that state, and which markets are you excited about lending in there?
Yeah, so I think Texas is pretty similar in terms of our house view to Florida, in terms of like there's parts of that market that have got quite sticky, and kind of you hear stories about sort of lenders getting caught up in sort of problems there. We've been less active in Texas, and it's probably less of a focus of ours, mainly because we don't sort of have the same sort of introducer base there that we do in Florida and certainly here in California. So, but it's statistically it's where we've done a lot of lending. Again, city center, not doing anything rural. All sort of SFR, pretty straight down the line business where we can. So yeah, not too adventurous there, but it's a key market.
And how about California?
California, I mean, California's good market. It's just super competitive here. And so I think I feel it is a market where it's slightly harder to price for risk and feel that you're getting paid the right amount, which is, I think, is a broad generalization across the market. There's certainly lenders that I kind of look at and say, obviously, they've got a lower cost base than maybe what we do, but even if I had free money, I wouldn't be doing the deals at kind of like 95% and 100 of rehab and all this kind of stuff. So there's parts of the market that just don't make sense to me at like such a ridiculously low rate. And so there's parts of California I feel like that is the case, but again, it's our home market. We're licensed here. It kind of makes sense for us to have a presence here, and we do a lot of a lot of business here, probably more in LA, but it's harder to sort of keep within our loan sizes, and so we're not doing large houses in Beverly Hills or anything like that, but blocks of land in the Palisades make sense, or kind of like smaller houses sort of fringe parts of LA make sense. And again, ultimately, we're just competing on speed and service. And as like I say, everyone says that they're quick and easy to deal with. But once a borrower has dealt with us, or certainly an introducer does, they kind of they see that, and they do bring us business. So over time, we kind of get that flywheel effect going, where people do come back and have a good experience, and hopefully we can continue to deliver for them.
Just to clarify, introducer, you mean a broker originator?
Oh yeah, yeah. Sorry, is that UK language? I was getting confused. Yeah, mortgage brokers typically. I mean, we've got some real estate agents that give us some business, but and also just there's a law firm that gives a bit of business. So broader introducers, but typically it's mortgage brokers. Yeah.
Okay. And are most of your deals coming from brokers, or are you getting to real estate investors directly?
It is more broker introduced than probably where we'd want to be in a perfect world. But having said that, the longer we're in business, the more we do have borrowers come back to us direct. So we're able to form that relationship. Obviously, that's a sensitive one when it's come to us originally through a broker, and we've got to sort of make sure everyone gets paid and it's it's a fair relationship. But we do, so we're doing more borrower direct business, but it's still it'd be 75% broker introduced at the moment.
And besides LA, what other parts of California have you done loans in?
Yeah, we've done, Sacramento, San Diego. We've done quite a bit down in, but again, that's an area where there's a lot of lenders down there. So it's sort of, it's hard to get the business, or you're scratching your head in terms of why it's come to us. But yeah, they're the two that come to mind, not being too adventurous. We did in the early days, we did some stuff out of like Joshua Tree and Palm Springs, but again, they kind of like not loans we're chasing at this stage. I think that market is a bit soft.
And and going back to land loans, because you mentioned land in LA, the types of land loans that you'd consider, these are mainly urban areas. Are you only looking at land that's going to be developed?
Yeah, it's got to be residential. It's got to be permitted and kind of ready to go. And ideally, it would have to be an experienced borrower that knows what they're doing. We're not going to fund the construction, but they've got a track record of being able to get construction financing. And so, yeah, it's a pretty sort of narrow range that we're going after, but there is a need for that, and certainly for these guys that and I want to be careful how I sort of phrase it in terms of that particular area, but there are opportunists that kind of like, if like, it's today's Thursday and they're going to complete next Wednesday and they're a cash buyer, or they look like a cash buyer to the seller, then, it could be a deal that makes sense, and one that we'd be happy to try and help out with.
Sure. And as far as leverage, you said 50 to 60%. Maximum, but what if it's a case
on land?
Yeah, what if it's a case where someone is cashing out equity on land? It's not going to be developed for the foreseeable. I mean, maybe it's more than 12 months out before it could even be developed. Maybe they just need the money for something else. How do you look at deals like that?
I think we'd be open to having a look at it. I think we'd want to try and understand what that something else is in terms of what that cash is for. I guess where we like to try and start that conversation is like, what other assets does the borrower own? Because, if they've got a big vacant block of land they don't really care about, maybe they've got other assets as well that we can sort of take a second lien against and just kind of like find our way to get comfortable with the situation. And again, if it's a very low LTV loan, then maybe it is something we'll do. I mean, ultimately, we're looking at the liquidity of the asset we're taking security against and trying to sort of calculate if we end up with this in a year's time, how long is it going to take us to sell it, and what are we really going to get for it? And can we be comfortable that our investors' capital is protected?
Are there certain areas that you wouldn't consider land, or maybe a state? Would you just say no to land deals in Florida versus California? Or
Not really. No, I think yeah, we wouldn't really have that approach to it. I think it is really trying to take a holistic view in terms of who is the borrower, what's their track record, what's their FICO score, and what sort of assets have they got.
and the exit strategy, obviously, of
Yeah,
how they're going to
exactly.
pay it
The
off
exit
within 12
ultimate,
months.
yeah,
Yeah,
is very key. Yeah,
sure.
yeah,
All right. Sorry for
yeah.
jumping around. I came back to land because I
No,
forgot to
not at
ask you
all.
those
Yeah, yeah.
questions earlier. But
Yeah,
I
yeah.
but I'm
I hate talking about land. We don't want to do that much land, but I keep saying that to the guys, and then they bring us one. It's like, this kind of makes sense. We can get our head around it. But across our book, it's like it might be like 15% of what we do. So it's probably a meaningful part of our book, but it's not something. It's not the sort of business that we're chasing. But I think it is a good example of where kind of it certainly doesn't fit the box of most of the rest of the market, and we can take a different view on it.
And it is an important conversation to have, because as soon as you say that you'll do land loans, you're going to get flooded
Yeah,
with all these land loan
it
requests. So you
is.
have
Yeah,
to
and
you
that's
have
why I'm
to
reluctant to even.
yeah, so you have to at least clarify that these are the types of land loans we do, and this is the leverage, and this is the situation. So that's
Yeah,
why
no,
I
I
spend
say
a
to my
little time
sales
on it.
guys, like when they're out on the phone talking to people, I was like, just don't even say we do land. Like, if it's kind of they got a land deal and they bring it to us, we can look at it. But yeah, certainly, and we learned that you put out the marketing material, it's kind of like that's all you'll be talking about for the next month. So there's an opportunity there. I mean, I think as if we had significantly more capital, maybe we'd be a little bit more aggressive with it. But I think at the moment, it's just we're trying to build a business that's going to be here for decades ahead, and kind of like just be sensible with what we do.
And assuming that if you did a land loan, it wouldn't be a $3 million land loan, which was the high end
Yeah,
of your
no,
loan amount range, right? You're probably talking
yeah,
less than $1 million.
yeah, exactly. Yeah, it's less than 1 million. I think around 500,000 is kind of where we're starting. We're sort of comfortable to write a check. Beyond that, we're sort of looking much closer. Yeah,
Okay, so I jumped around a little bit. I'm going to come back to
yeah,
geography. So we talked about Florida, Texas, California. Tell us about some of the
yeah,
other smaller states around the country that you lend in, that you've done loans in lately, and which ones
yeah.
you like to lend in.
I think without wanting to sound political, it kind of feels like the blue states are often the harder states in terms of like slightly less lender friendly, or I'd say business friendly. So Massachusetts, um, Oregon on commercial side, we can lend in. I think they're two states that we've done some stuff in. I don't think we're actively kind of like trying to push more into those states. Um, but obviously California is a pretty blue, and it still is a good market. So that's a bit of a broad generalization, but yeah, I think we're kind of it depends more on the asset and the opportunity and the liquidity of kind of the area and the sort of demographics of what we're dealing with. So it is trying to sort of have a box that is not a box, in terms of like it's more of trying to let our underwriter have a good understanding, get a good understanding of what the story is, and see if it's something that we can partner with that borrower on.
Sure. And what are some of the smaller states outside of the big three that you'd like to do more loans in?
Yeah, so I think Arizona is a state. Like I say, we recently got licensed there. I think that's a state where kind of you've got the licensing sort of threshold, so there's probably less competition, which is part of our thinking of being there. We've got an introducer that we know pretty well that is able to send us some business from the state. So keen to try and do more there. And uh, yeah, Georgia, South Carolina, those states are pretty good, although they're not necessarily small, but yeah, but small, and obviously in California and so on. So yeah, there are some states we're happy lending in. Yeah,
And how about the DC metro area, Virginia, Washington, DC, Maryland?
yeah,
Is that a market you're
we,
excited to
it
lend in
is.
more?
Yeah, I think it's not a market I'd say I personally know particularly well, but we have lent there, and it kind of makes sense. But again, it'd be on a case by case basis. But yeah, but we are active in that state.
Have you approached being able to compete with lenders in these different markets? Are you just getting these mortgage broker relationships that like what you offer and they're sending you business? How do you break into those markets?
Yeah, it's a good question. I mean, so we've got I've got two loan officers that are actively on the phones and kind of like doing the conference circuit and kind of like networking, pretty aggressively. We've got a pretty good marketing list. I think we don't take ourselves too seriously on the F2 finance side. It's kind of a fun email that goes out every 2 weeks, and that kind of makes the phones ring whenever that goes out. Um, and I think we just try and compete on having that kind of like a vague credit box, but we always pride ourselves on giving a fast no as well. So, there's a sort of pitch to a broker is kind of like, make us your first phone call because it'll take 5 minutes and we'll tell you no. And we pride ourselves on knowing the market relatively well. We might even be able to tell you a lender that is worth going to have a chat to. And if it's a yes, we're not going to mess you around and kind of like, we don't have to go and answer to an institution. We're not selling the loan. We are a balance sheet lender. If we're giving an initial appetite for the loan, if you're telling us the true story, or as kind of the what the situation is, we'll be able to give you an answer and give you a feel for what our true appetite is. So it is kind of like speed and service, which, like I say, everyone says they're doing, but once someone experiences with us, they will see that. And I think that goes through the life of the loan. So we use a lot of technology here. We're using AI. I know probably everyone says they are, but previously built a technology business myself with 100 engineers in it. So I'm pretty savvy with the technology side of things. We've got a little in-house system that we've been building that can again help us give a view on an assigned appraisal, for example. If someone comes with an appraisal, we could run it through our system in 30 seconds, tell you if it sort of fits our general sort of credit box and whether we've got an appetite for it, through to using, I think you'd be familiar with like Petra Loan Servicing, who, when I met Joe a few years ago and he was setting Petra up, I kind of thought he was pretty mad, want to sort of set up a loan servicing business in this space. But his vision was pretty ambitious and he's very tech enabled. And we've had a very good experience using them as a servicing platform. So that kind of makes the whole experience great for the borrower as well. If they need a payoff, they get it pretty quickly. And so that helps us give the borrower a good experience, not just at the front end in terms of getting the capital very quickly, but also through the life of the loan, through to completion. And ultimately, we want them to come back to us. I think the best source of business is your existing book of business. So if we can be a good capital provider and a good partner for a borrower, they pay their interest, they pay us back, then for sure we want to lend to them again. So that's kind of that's how we compete. It's kind of it's a vague messaging and it's hard to sell because I think everyone is saying that, but I think once a borrower or a broker has experienced it, they become relatively sticky with us.
Great. And you mentioned appraisals. How do you approach appraisals? Or are you requiring an appraisal on every property that you lend on?
Yeah, we say we do. I laugh a little bit because I do think appraisals are a big issue for this industry in terms of, I would say that it's probably unfair and it's a broad generalization, but the vast majority of appraisals are junk. They kind of like they're nice pieces of paper with lots of words on them, but kind of like don't make a lot of sense in terms of just our own desktop work, in terms of what the true value of a property is. That's why obviously we like purchases better because you kind of like got real cash going in. You've kind of got a bit of a sort of a sense point to, or a data point to sort of hang some sense to. But yeah, so to answer your question, we do require appraisals, but we can often take an appraisal post completion if it's really, if there's a, like if there's an earnest money deposit at risk, it's a purchase and it's like a 60% LTV with a 700 plus FICO borrower, we can get the appraisal post completion, or maybe we can even just get a BPO. But we always want something for our records, and that's part of our pitch to our investors is, we're always having an independent, experienced, verified set assessment of value. But I think increasingly, as I get more involved in the business here in this market, I kind of feel like it's it's like a data point. It's not something we necessarily would just hang all of our reliance on. And interestingly, like different to the UK market, where when you get an appraisal, what they call it valuations, there the value is insured, and in my last business, we've sued valuers many times and very successfully recovered. It just becomes an insurance matter. So if you've lent to someone on a 12-month basis and 12 months later you're trying to sort of recover your capital by selling an asset, and you sell it for 30-40% less than what it was appraised at, you've got a claim there. Where in the US, it's kind of you got nothing. It's just a piece of paper. So yeah, it's something we require. It's a bit of a rant there, but yeah, I think it's not something that is the most important thing of the underwriting process. I think if anything, it's just having someone go into the property, make sure there's not concrete down the sink, or the kind of like the place is a total mess inside, which I know, everyone's seen who's been in the industry long enough. You've seen those sort of disaster scenarios. So I think it's kind of it is useful to have someone sensible go inside and take photos and kind of like give a view on it. But I think that's all it is.
And then let's switch gears a little bit. Let's talk a little bit about your company and your capital. So you told us a little bit about the journey of starting F2 over the last few years. Tell us a little bit about your operation and your office location.
Yeah, sure. So we're based in Santa Monica here in Los Angeles. Normally beautiful weather, but not today outside. We're an office-based team, a small team. There's only 10 of us at the moment, but we are all in the office, pretty old school. I kind of feel like we are a startup and sort of trying to build a startup culture where it's very collaborative. People can swing around on a chair and talk about a deal or, what's happening. And also, as you touched upon, so the way we're funded is we've got our own fund that we market to accredited investors. So there's a couple of guys here that are, all day, every day, sort of meeting and talking to accredited investors, high net worth investors, and sort of building relationships through RIA channels. We've recently got our fund approved by Charles Schwab, so it's on that platform. So kind of like it's a good sort of channel of capital for us. And we have two institutional funders that sort of invest alongside our fund. They're UK institutions from my previous life. One is a private credit fund that was actually the first capital provider to my UK business, and they've followed me over here and sort of backed us with capital for lending here. So yeah, we've kind of got capital that's not the traditional capital for this market, which comes back to us sort of having that credit box is a little bit different. Ultimately, our capital is discretionary in terms of the way it's set up. So we are able to sort of take a view on a deal, sit around the table, and see if it makes sense. Kind of old school, hard money lending, I guess, in many respects.
Nice. And so that was where you mentioned earlier the SPVs. You have two different ones that you might lend under if it's not F2 finance technically.
Yeah, exactly. We've got three different vehicles. One's the fund, F2, and then an SPV. But they're all SPVs under our sort of group parent.
Okay. And as far as F2 finance, the fund, what's the size of the fund at this time in terms of
we don't say
assets under management?
Yeah, we don't say.
Okay.
My issue with that is if I say a number, people might say it's too small, and then it'll be bigger next week. It's always we're always raising capital, so yeah, we've got about 100 million of capital across the sort of three funding sources that we've got.
That's very impressive. Still, what about the types of investors that you're looking for? Are you mainly dealing with high net worth investors, and tell us about the fund opportunity?
Yeah, so the fund opportunity, it's a great opportunity for investors. I obviously would say, it's a relatively unique product. So we offer investors a fixed coupon, which is different to, I guess, a lot of other real estate focused funds. And it comes back to which is exactly the same way we set up our first fund at LendInvest. And I remember them sort of doing research. And when I got here, I did sort of sense check that research. And a lot of sort of criticism of real estate related funds or even lending related funds is, well, the fund targeted an 8% return, but only paid me 5 the last 3 years, and there's sort of no recourse for that. And so kind of people just take the targeted return with a grain of salt. So what we've done is we've set up a fund that just pays a fixed return. It's kind of like a high yielding bond, but it is structured as a fund. If you invest over $250,000, we pay 9.5%. If you invest less than that, we pay 8.5% per annum, and it's $100,000 minimum, and it's only a 1-year lock-in. So we're kind of like matching the underlying liquidity of the loan portfolio that we've got. But most investors kind of reinvest and sort of compound their return, and we touch wood, we haven't really had any redemptions in the fund yet, so it sort of continues to grow. And I think as we just continue to say what we will do, the one that says on the tin, or does what it says on the tin, people kind of like stay, and actually most people just re-up and invest more over time. And those investors are everything from private individuals, obviously got to be accredited investors. It's a 506c Delaware LLC fund. But we also have a Cayman feeder fund. So the fund was originally seeded by a sort of network of high net worth investors I had from Europe that came in through that Cayman feeder. And so it's a great product we've got a couple of investors like in Dubai and Singapore, for example, so tax-free jurisdictions where they get paid this return, net of withholding tax. So it is quite an interesting product, particularly for, say, an offshore investor that is interested in getting exposure to the US residential real estate market and sort of get a fixed return in sort of a very tax efficient way, through to kind of like domestic self-directed IRA investors. And obviously, like I said, that the RIA channel is really what we're trying to crack. And we're getting some pretty good traction there, but it's a long sales cycle to get in front of an RIA. Sometimes you could just educate them as what is private money, and then and then go from there and sort of get them to the point where they can get comfortable to sit in front of their client and talk about it. But yeah, that's kind of what we're doing on the capital side.
Nice. And the Cayman entity or fund, is that something you have to set up in order to get international investors?
We didn't have to, but it just makes it much more attractive for an offshore investor, because if we didn't have that, then an offshore investor would have to file US tax returns, which having sort of experienced tax jurisdictions in other markets coming to the US, like, it is something you should try and avoid in terms of like it's pretty extensive process with the IRS here, and also with the Cayman vehicle, we're able to do it in a not only no tax returns, but it can be effectively paid up gross and sort of sort out the withholding tax there. So that 9.5% return, which will lower over time, but that's what we're paying at the moment for investors that come in. They receive that whole 9.5% return.
Interesting. Yeah, that's a unique structure that I haven't heard of from other funds, as far as I know.
Yeah.
Excellent.
Yeah, it is unique. Which is, I think that's good, because it's a good conversation to have with people, but also there's a bit of an education process for people to get their head around. Like, is it a bond? Is it a fund? Like, well, how does this work?
I think initially an investor might question, hey, what if at a particular time there's a loss or something significant happens? How are you able to continue paying that fixed return?
Yeah, so that's a good point. So, and it's something I should have mentioned, because going back to that criticism of other funds that kind of say they're going to pay X, we're kind of just doing the same. Obviously, it can't be a guaranteed return. That would sort of blow our attorneys' minds up. It would just be silly. It's not a guaranteed return. So it is a fund that can be gated in a worst case scenario, and there could be losses, like capital is at risk. But to show our confidence in being able to achieve that, what we've put into the documentation is essentially a self-destruct mechanism, so that if we don't pay that full return to investors in any 2 quarters, then the fund automatically winds up, and we as the manager sit last in the waterfall. So basically, if an investor kind of does invest in that scenario where kind of we're promising 8.5 and we deliver 5 in any 2 quarters, then the fund winds up, they'll get their capital back, plus the sort of, they've got to make up that return, and then we would sit last. Obviously, not sort of, I haven't made this investment and sort of, I've got a large part of my net worth in it as well. We're not doing this because we think we can't meet that return. So yeah, we're kind of pretty conservative and cautious in terms of how we are constructing the portfolio, with a view to ensuring we can sort of as a bare minimum, hit that return for investors, which means, when it comes to competing with a lot of the sort of mainstream lenders that lend at 95% LTV and 100% of rehab and kind of do that at an 8% coupon or whatever, that's not the business we're going to be able to compete in. And I just don't think that makes a lot of sense from a pricing for risk perspective anyway.
Absolutely. All right. And then final question or topic is tell us about your thoughts on private lending in 2026. What are you excited about for this year? What are your thoughts on how it's going to play out for the next 10 months?
How's it going to play out? I mean, I think it's interesting times. I think just from a macro perspective, lower interest rates, I think, is good. It feels like the last couple of years have actually been like interesting time for me to be setting up this business, because it doesn't feel like it's a bull market by any stretch. It's just, if you look statistically at the volume of transactions for residential house sales, like you can see it's not particularly a strong market. So that should ease up, I think, with interest rates coming down. I think there'll be more supply into the market and maybe more demand as well, with people sort of looking at the end buyer and sort of able to afford a mortgage as rates come down. I think what I've touched upon in terms of things, it's interesting to see some lenders have been hit with big frauds and things like that, and obviously don't wish ill on anyone in the market, but it feels like there has been a huge amount of capital chasing what ultimately is a finite-ish opportunity. And so I just wonder if some of that comes home to roost with some lenders, where they kind of have been super aggressive. I mean, you can be the smartest lender in the world, but if you're lending at 95% LTV, I mean, there's not even margin for error. The market's just got to move a little bit and you're out of whack. So obviously some of those lenders take a portfolio approach, but there's going to be limits to what amount of pain some people will want to take with that. But again, maybe the market sort of saves them in terms of like the, more liquidity comes back in and so on. So yeah, from my perspective, we're kind of just, I go to the conferences and try and sort of build relationships in the market and get to know everyone, and sort of just want to be a participant in this sector for a long time here, and just for us, just put our heads down and, keep building the business inch by inch, and sort of just trying to keep growing year after year.
No, love it. All right, Christian, that's all I had on my list for today. Anything else I missed? Anything you'd like to add?
No, it's been comprehensive chat. No, I appreciate you having me on the show and the opportunity to participate.
Of course. Yeah. Thank you for your time, and look forward to seeing you at a conference coming up in the next few months.
Yeah. See you soon.
All right. Thank you, Christian. Take care. Bye. And that's a wrap for this episode. F2 Finance is listed on privatelenderlink.com, and they pay a monthly subscription to be on there. Visit their profile. I'll put a link to that in the description. You can contact them directly by phone, fill out a short email form, or a detailed loan request form. When you reach out, be sure to let them know that you heard about them from LenderLink and the Private Lending Insights podcast. Thank you for tuning in and listening all the way to the end.